I was muted. Hey, Ron. Hey, Shelby.
Oh, hey, how's it going? Hey, Shelby.
I just realized I was talking to you guys and I was muted.
Oh, sorry. I thought you were just talking to somebody else around, but yeah, I also just briefly.
Yeah. You probably were like, wow, they're being really huge jerks tonight.
Nothing's changed, yeah.
No, don't worry, Ryan.
Never ignore you like that, Ryan.
I actually thought that my speaker is not working.
I did just check my speaker as well. I was just, yeah. Like I sometimes have that issue.
That is really funny.
Did you get a haircut, Ron?
I did get a haircut. I've been putting it out for a while, but well, today's not really the perfect day for it, but it had warmed up kind of nicely for a couple of days there, and I was feeling like I could use a little less hair on the head.
I feel you, man. This is starting to get pretty
long. Yeah,
long.
you really let that go. It's getting really long.
I know.
Is the bun pretty permanent?
I don't know. I kind of dig it.
Yeah, no, it looks good.
I mean, all this stuff has to like get trimmed up eventually, but I kind of like, I've had long hair before, so.
Oh, okay.
It just takes so long to grow it out that it's a big decision to cut it back off.
Absolutely. Yeah. Yeah, the stuff on the neck really bothers me.
Yeah. Shelby, what time is Andrew gonna start?
He's supposed to jump on now. Okay. I'll probably do what we normally do and give everyone like 5-ish minutes past 6 or whatever to jump on. And then I'll kick him off. Just welcome everybody, kick him off, let him go. He'll go for 30 to 40 minutes. And then I'll cover the rest.
Okay.
Yep.
Is Brian is not going to come today?
No, Brian is out of town. We have had quite the 2 weeks because we're all friends, the 4 of us are, but my fiance, my birthday, Brian's wife, and Brian's birthday are all within like a week of each other. So we, have done some stuff, but Brian decided to take his wife out of town for her birthday. So I was like, got it. We've covered all this in different walks of life at some point before. So.
Yeah, definitely.
Yes, but my name is Brian on the screen, which I have shocked several people. I'm doing interviews for the Imagine You program that the University of Memphis runs. And oh my gosh, I logged on the other day and I scared the director of the center, I think kind of bad, because he was like, I was expecting Brian and I'm just really jarred right now because you're obviously not Brian. I was like, no, I'm not Brian. Yeah. I have to switch my Zoom back over.
Well, Ryan is here and Shelby, you are here. So I just wanted to let you guys know that one of the team members, she is from UT. She dropped out of our team last week. She said she have some personal problems going on or something like that. I don't know what exactly is, but yeah, she did drop.
Okay.
Okay, thanks for letting us know. What was
Carol,
her name?
Carol. Team
Okay.
2, Carol.
Okay. Thanks for letting us know.
Yeah, but Caitlin is still there, and our team had a very nice meeting just day before yesterday.
Good.
It was great brainstorming sessions. Everybody gave input quite a lot. So
awesome.
Yeah, it was awesome.
Good to hear that. Okay, it looks like we're tracking well with people. I'll give everybody like 2 more minutes and then we'll go ahead and get started just in case we have some stragglers.
So who is going to talk, Shelby, today? It's you and Andrew. Okay.
Andrew, who's waving his hand. Andrew's gonna talk for a while, 30, 40 minutes. Really however much time he needs because the information is really valuable. And then I'll kick it off after that and we'll go over some more things.
Awesome. Sounds great.
Probably
Thank you so
take the
much.
full time tonight, I would think.
Yep, yep.
I was hoping that we could, I could give y'all like 10 minutes back. But I think it's just a lot of information and it's good. So it's worth it to take the full time.
Awesome.
Probably going to try to talk for 5 or 10 minutes, stop to wake everybody up, talk another 5 or 10 minutes, make sure everybody's awake and kind of go like that.
No, I'm pretty sure it's gonna be interesting. So probably everybody will be listening and nobody will sleep. Don't worry.
Right. Accounting and finance is always riveting, especially to scientists and engineers. It's always a very familiar topic. Pick it up right away. It's good stuff. Shelby, while we're waiting, if any of the boards want to talk about like what their projects are, that might be interesting to kind of fill the time if anybody wants to tell me what they're working on.
Okay, yeah. If y'all want to go team to team, if there's somebody on and give, we have not practiced pitching yet, but 30 seconds or less of what you're working on.
Kind of the elevator, we're making this to address this problem.
The extreme elevator pitch, which this is great practice. So if anyone from team 1 is on, go ahead and dive in.
Or if anyone just wants to volunteer, because we definitely haven't practiced this with them at all.
That
Yeah, I
works.
was gonna say, I don't want to like make anybody too nervous or anything. So voluntary basis only. And this is not for judgment. This is just for me to get an idea of the types of things y'all are working on.
Okay, hi. This is Pandurang from Team 1. Can you hear me?
Yes.
Yeah, okay, great. So to describe in one sentence, our company aims to provide a scalable and cost-effective solutions with high sensitivity and specificity in DNA deep sequencing that is used by liquid biopsy industry and drug-resistant management in infectious diseases and beyond. And to say, deep sequencing is the foundation method for detecting minuscule amount of mutations in a given sample. Therefore, it is frequently used in tumor early detection in plasma samples known as cancer liquid biopsy. However, it is well known that DNA sequencing has a non-negligible error rate that could confound with the real mutations. The current methods employ DNA-based biomarkers followed by deep sequencing and subsequent bioinformatics approaches for detection of ultra-low frequency cancer mutations in blood samples. However, mathematical modeling shows that the barcoding method is unlikely to uniformly cover the whole genome. Therefore, there is a desire to systematically reduce error rate in deep sequencing to enhance the sensitivity and specificity of the liquid biopsy. Yeah, and that's what we are trying to tackle the problem. Yeah, thanks.
Gotcha. Thanks.
Well, it looks like, I'm glad that team 1 had time. It looks like we're going to go ahead and have to get started though, because we have quite a bit of the participants on. Some people come in and out within the first 10 to 12 minutes, I've noticed. So let's go ahead and get started. I'll share my screen first, and then Andrew, I'll transition off and let you share. No, 1 second, y'all. I'm opening up the wrong thing. Can everyone see that? Okay, gotcha. All right. Well, welcome to week 5 of Memphis Scipreneur Challenge. So this week we're going to go over finances. And also, so for those of you who weren't on the call early, Brian is out of town this week, so I'm covering it, but we have a great guest speaker. So yeah, we're just going to get going. Thank you all for submitting homework. I don't know if I got back to every team, but if I didn't, if you have homework that you want to put, this is from this past week and any prior documentation you have edit access to your drive now, your Teams folder, so you can upload whatever you need to upload, just FYI. Okay, so this is the agenda for this week. We'll go over startup finance and economics. That's what Andrew's going to cover. And then I'll walk us through channels and biz dev, corporate formation, and then time permitting, we'll get into some Q&A. Okay, so startup finance and economics. We thankfully have Andrew on the call who's going to walk us through this. He is the founder and partner at Sage Business Advisors. So Andrew, I'm going to stop sharing my screen and I'm going to let you, I think I made you co-host already, so you should be good to go.
Of course, I was on mute. You had to have at least one, one time that you try to talk while you're on mute. I'm going to do this. Okay. Let's see. There we go. Are y'all seeing my screen still? Yep. Okay. So this is accounting made simple, sort of. It's maybe not simple for everybody. And for me to be able to see the whole slides, I've had to kind of minimize you guys so I can't see anybody. So I'm going to stop every once in a while and check in and make sure everybody's doing okay. So the financial statements, just the basics of accounting and financial statements, all that side. You have three primary financial statements. You have a balance sheet, an income statement, and a statement of cash flows. And a balance sheet is where that represents where a company stands at any point in time. So as of December 31st or as of March 31st. So at a point in time, and it's how much, assets, liabilities, and equity. And we're going to get a little more detail on that. Both the income statement and the statement of cash flows are for a period of time. So an income statement measures the revenue and expenses for a period of time, for the month, for the quarter, or for the year. So basically what was happening to the business from what you brought in from revenue and the related expenses. The statement of cash flows kind of reconciles the two of those things. And it basically tracks what happens to cash over that period of time. Because an income statement, you can say, oh, well, we sold $100,000 worth of the Groups 1's tests, and it cost us, $30,000 to deliver that, and we paid ourselves salary. But if whoever you sold it to hadn't paid you yet, then you didn't net that much cash. And so that's what the statement of cash flows does is help recognize those differences, the increases in inventory or decreases in inventory and accounts receivable and those things. So a balance sheet, you have assets, liabilities, and equity. Assets are tangible or intangible things that are of value. So cash, we'll get into some examples of it on the next slide, but it's basically, if one way I thought about it when I was learning accounting is assets are good. Okay. Assets are the good things. Just as, if somebody talks about assets of a person or a business or whatever, those are good things. Liabilities are bad. Liabilities are what you owe to other people, and equity is the difference. And if your assets are more than your liabilities, then you have positive equity, and that's a good thing. That's what you want. If your liabilities are greater than your assets, you have negative equity, and that's not good. You don't want that. When the formula is that the assets are going to equal liabilities and equity. So some examples of assets are, well, let me stop there. Are there any questions? Brad has a question.
Since you asked, I was curious, like what an intangible asset how do you assign that value? Is that like an IP asset that you have?
Yeah, and typically that's going to give rise. It'll give rise, so intellectual property is listed there. Goodwill is another one that usually occurs when something is purchased. A lot of times you'll have that, and there have been different rules, but that have kind of changed over the years. But sometimes startup costs will get capitalized. There are, some research and development can be capitalized under certain circumstances. So those are intangible. You can't point to it. It's not a building. It's not a thing. So those are example. So here are examples of assets: cash and cash equivalents. Everybody knows what that is. Prepaid expenses. A lot of times, if you have to make a deposit on some, like if you guys are building, anybody's doing a medical device, and you are hiring an engineering firm to build out your device, I'd say almost 100% of the time they're going to make you do a deposit. So if it's a $200,000 project, they might ask for $40,000. So you would put a prepaid expense. You would so you would have that prepaid, and then later on at the end of the project, when they're sending you the invoices, you won't have to pay any cash out because they'll apply it to your prepaid, your deposit that you had done. Other examples of prepaid expenses: if a company had a really large like insurance policy that they had to have. So let's say it's a $60,000 insurance policy that you have to pay that in March, but it goes from March until the next February, then you would have a prepaid of $60,000, and each month you would expense $5,000, and as the year goes on. And so then that prepaid expense would go down, and then the expense would hit the income statement at the right time period. And that's one of those things when I talked about the statement of cash flows. So your expense in March would only have $5,000 of insurance expense, but on your cash impact, you had $60,000 go out the door. And so that's what that statement of cash flows does, is to help reconcile and show that difference. Accounts receivable: when you sell something, if they haven't paid you yet for it, that's an account receivable. Intellectual property, we've talked about. Inventory is pretty obvious. Fixed assets, buildings, equipment, etc. Some examples of liabilities: accounts payable. So if that engineering firm has done some work for you, they're going to send you an invoice for the work that's been done, and you haven't paid it yet. That's an account payable. So you've got something. In your personal world, you can think of that kind of like a credit card, right? You've charged something, you've incurred something, you've gotten the service, you've gotten the product, you've gotten whatever it is, but you haven't paid for it yet, so you still owe it. That's accounts payable. Accrued expenses are things where you've incurred an expense, but you're either not going to get an invoice at all because it's just something that you're going to have to pay, or you haven't gotten the invoice yet. So if you have, let's say, legal fees, that's another good one, that you may know that you've incurred $50,000 of legal fees, but you haven't gotten an invoice yet. So you haven't been able to put that in there. It's not in accounts payable, but you want to show and recognize that you owe that money. You would record that accrued expense, which also then, so it shows the liability. It says, hey, we owe this money, but over on the other side, on the income statement side, it's showing that expense occurred during that period. So during that period, it hits the income statement of there's this expense in March for the legal fees. And at the end of the period on March 31st, it shows, hey, we're going to have to pay this. We haven't got an invoice yet, but we're going to have to pay this. And then things like loans are also liabilities. Equity. So basically there's two primary parts. You've got capital contributions, so the investment part, and then retained earnings. Retained earnings is capital contributions, the amount that people have invested in the business, and then retained earnings is a running total of your income. It's probably a little too much to get into here. I am going to share some documents that I had shown Shelby and I'd shared with Brian in the past that is going to capture all this stuff. So if anybody is out there feverishly taking notes, you don't need to. You'll get all this stuff in the form of more of a document, not a deck. Brad has another question.
What about like typically sometimes a startup will have promissory notes, I think is what they're called.
Yeah,
Like, well, where does that fall under in equity?
that's back under liabilities.
Okay.
So there are, and then there's one thing that you'll hear the word safe or the term safe thrown around, and that's same as future equity, or I think there's another interpretation of the acronym, but basically that one's a little, I think it does technically end up fall under liabilities, safe agreements do. But they're almost somewhere in between equity and liabilities, but I think they technically are classified as liabilities. And that's not unlike a convertible loan or convertible debt. So yes, it's an investment. It is something that maybe is eventually going to convert into equity. They know they're not trying to get their money back right now. They're going to get it back in the future, but that still technically is a form of debt and would go underneath the liabilities.
Thanks.
So the income statement records your revenue and your expenses. So whatever you charge for your product or your service, and then you're going to have all the expenses related to that. And that's the expenses of the products and services themselves, and then any other compensation, et cetera. We'll go through some of those in a minute. The difference is your net income or your net loss. And again, an income statement covers a period of time. So it's for the quarter ended March 31st, 2021, or the 6 months ended June 30, 2021, or the years ended, December 31. And a company's fiscal year does not have to follow a calendar year. Most of the time it does, just because it's simple. But you can have your fiscal year, fiscal meaning your financial year, you can have it end whenever you want. I don't know if it's still true today, but back when I started in public accounting 20 something years ago, almost all retailers had their fiscal year end on January 31st. And the reason was that, of course, the Christmas holidays. So it was really hard. They would have stuff, and then it was really hard to close the books and have their end of year on December 31st. So they would have theirs January 31st just to make it easier. Technology has made a lot of that stuff easier today, but there are companies that do June 30. One reason you might pick something like a June 30 fiscal year is that then if you're getting an audit where a company comes in and makes sure all your records are correct, they're not as busy in that time period, so it can be a little bit less expensive, and you can get your audit done quicker in closer proximity to the end of your fiscal year. Questions of the income statement?
I was just gonna say, it sounds like the only reason why you'd not have it on your calendar, the actual calendar year, is just to avoid like a busy schedule, right?
Yeah, and I think that today, just with taxes and all, it's just so much easier to have your fiscal year so that you're filing your taxes along with the other. For medical device or any kind of medical sales or labs or whatever, I don't know any reason you wouldn't just have, December 31 as your fiscal year end. It saves a whole lot of explaining. I remember we have one client where it was on, I forgot what they called it, but it was like on a 52, like it ended the last Friday or the last Sunday of the year. So anyway, it moved around. So then so sometimes it might be December 27th, then it'd be 29th, then it'd be December or January 1st. And then anyway, it was a pain. It was terrible. Okay. So the income statement, revenue, examples of revenue are like, if you have a medical device, what you charge for the medical device is revenue. If you have an app, then it's, downloads or purchases within the app or those types of things. From that, you're going to deduct your cost of goods sold or your cost of sales. So if you are selling widgets, if you're selling a hard good, well, then that's a cost of goods sold because that's a good that was sold. If you are providing some sort of a service, then your line there is your cost of sales, because you don't really have a widget. Like if you've done, if you mow somebody's grass, that's a cost of sales. The difference between the revenue and your cost of goods sold or your cost of sales, which COGS, you might hear that phrase, COGS, COGS, that's cost of goods sold. So the difference between revenue and your cost of goods sold or your cost of sales is your gross margin, and also called your gross profit. And you'll hear people talk about your gross profit margin. That's important, because if that's not positive, you cannot make it up in volume. Okay. No matter how many more you sell, if you're not making money right there at the margin, you'll hear people talk about what are they doing at the margin, or what's the gross margin, or what's your net margin. And they're looking for a percentage. And it's what is good and healthy is different for different businesses. If you have a business that doesn't really take a whole lot to deliver that product or service, well, then you might have thin gross profit margins. Or if you have really, really, really high volumes, then your gross profit margin may not be very big. But you got to do a lot of that volume with just a few people and just a small amount of expense in order for the company to be profitable. And a lot of what you guys are probably doing, you should have pretty healthy margins, just generally speaking in the healthcare. Expenses are, so think about it, cost of goods sold and cost of sales are things that relate to, that are almost directly relatable to the revenue, okay, to whatever you sold. Expenses are generally things that are related to a period of time. So you'll hear in cost accounting, you'll hear the terms product cost and period cost. So product costs are things that are in the cost of goods sold and cost of sales. Period costs are things that happen in, so let's take the month of March and let's go back to group one. They're selling their licensing or selling their tests to do some analytics in the lab and say whether the person's sick or not, or what they're going to do, or what medicine, all that. Well, the running a test is something that is related to the revenue itself. So that goes in cost of goods sold. Compensation for the employees are going to happen in the month of March, regardless of whether you sell anything or not. So that almost all of the expenses pretty much are going to happen whether you've sold anything or not. Now, of course, there's some that move up and down, like travel. If you have to go and deliver something, you're going to have travel related to it. Then your travel may be higher when your sales are higher. And, if you're marketing, if you spend more on marketing, then you might have more sales. Hopefully you do. But any of those things that are really related to a period of time are things that are going to be under just the expenses, like compensation, research and development, legal fees, rent, occupancy, admin, travel, meals and entertainment, any of that stuff. I don't want to get real technical on this. At that point, you have what is referred to as Ebit or Ebitda, and that's earnings before interest, taxes, depreciation, and amortization. And so in a lot of businesses, they like to show those things, interest, taxes, depreciation, amortization, on their own lines, just to separate those out. And part of the reason for that is that if somebody comes in and buys the business, those things could be appreciably different for them than what it is for that current business. Go ahead, Brad.
Yeah, so I've heard this before in different areas of businesses, like software companies are always using Ebitda to determine valuation, and like medical device companies, they're always looking at top line revenue to determine valuation. Like why the difference, I guess, amongst industries?
So for one thing, the what the interest, the taxes, those for sure are going to be different for different companies. And so whoever an acquiring company is going to figure that out for themselves. So if you have that separated out, all the other stuff in theory is going to be about the same. And so it's easier for them to work with Ebitda because then they don't have to back out all this other crap where they would have to then put in their expenses, right? And what it would cost them. And so that's why it's easier to kind of work with Ebitda. For some companies, they may want to know, or if they have a pretty good idea of like what margins are, then they may not need your team to deliver whatever the product is. They don't need like and they know, again, they kind of know what their metrics are of what they're going to spend in R&D and what they're going to spend in compensation. And so they can just take a top line revenue number and multiply that by whatever, 1x, 2x, 3x, whatever their metric is. And then they know what the associated expenses would be. And then they know how much they should be able to make from that.
So it sounds like the differences are really who's purchasing the company and what matters to them is really
right.
Because they'll have their own expenses or they'll have their own different areas that they're concerned with to determine whether to purchase you or not, I guess is what I'm hearing.
Right. Exactly. So because they know what all those things are, they look at that as a percentage of revenue and they know what their percentages are of that revenue. And so then they know what they can afford just using the top line number. Now they'll want to know kind of some of the margin information to make sure that margins are in line with their expectations. But then sometimes you'll hear people, it's 3 times sales or this and that. Ultimately, I mean, you can take whatever number and then back it into those calculations and say what it is. But ultimately, what an acquiring company is going to do is what is this worth in our hands versus what is it worth in their hands? And as an entrepreneur and you start building something up, that's what you have to look at. You look at, okay, in the next 3 years, I can sell 1 million widgets. But if I sell this to this company, they can sell 20 million widgets because they have the infrastructure to do that. Well, then it's worth 20 times more to them as it is to me, but you don't get all that difference. You get a little bit of that difference. And because they're buying that, then they're picking up some of that difference. And that was
otherwise it's not beneficial to them.
Right? Exactly. Why would they do it? Yeah. So that's what makes a good deal is hitting that difference. So statement of cash flows, again, this is one that's in a period of time. And going back to that example I gave earlier of paying the insurance. So in a particular month, you may pay, $60,000 for some insurance and that lasts for a year. So in that period of time, if you're looking at the income statement, you would show an expense of $5,000. So let's just say for kicks, you had revenue of $10,000 or gross margin. Let's use gross margin of $10,000. And you're working for free. You had no compensation. You had nothing else. And you just had the insurance expense. Actually, I'm going to back it all the way up. You sell something for $20,000. The cost of the unit of the thing that you sold is $10,000. So you have a $10,000 gross margin, and then you have $5,000 insurance expense. So if you just use the income statement, you would say, okay, I made $5,000 that month. That's great. But that's not what happened with cash. Here's what happened with cash. You had to build this thing that you sold. So $10,000 of cash went out the door. They bought it. You have an account receivable because they're not going to pay you till 30 days later at best. So you've got $10,000 out the door. The $20,000 of revenue didn't come in, and you had to pay $60,000 for the insurance. So your cash flow was negative $70,000. But my income statement said I made $5,000. So that's what the statement of cash flows helps you figure out. And that's where the other thing that comes in, financing. So in that you had an investor maybe who also invested $100,000 that month. So now the net cash difference is only $40,000, or not only, it's actually $40,000 positive, and it went up $40,000 because you had that $100,000 investor. Investing activities, that's a little too deep. I can go into that later if we have some time. That's like buying equipment. In that same example, let's say that you know, to build your $10,000 product, you had to buy a $20,000 machine. So through investing activities, you were out $20,000. Financing activities, it was positive $100,000. Operating activities, you were negative, whatever we said, 60. So, you know, so you got 30 left in the bank, something like that. Does that make sense? Kind of, sort of.
Yes.
Okay. Forecasts. Forecasts are something that you guys are going to need to learn how to do. And a forecast basically is your best guess of what's going to happen in the future. There are forecasted income statements, balance sheets, and statements of cash flow. However, what most investors are really looking at are they really want to know on that income statement, and then a reconciliation, the statement of cash flows, to get down to that. In a roundabout way, you actually are coming up with what the balance sheet would look like. It's mostly cash and accounts receivable and accounts payable. But those are good sometimes to help you realize what is happening with the cash, given my example that I just gave you, especially if something is front end loaded with some expenses, or equipment you have to buy. You have to really understand that for the cash flow. Here's one thing about forecasts. They always look good. I'll tell people, say, oh man, you ought to look at this company, man, their forecast looks great. They all should look good because they are made up. Okay. All of the numbers in a forecast are made up. And if you can't make up good numbers, well, then you should not be in the business of what you're doing. All right. If you make up numbers and it looks crappy, well, then stop. Okay. Don't do whatever it is you're doing because it doesn't make sense at that point. Or relook at your business model and see what could be different. The key is, what are the assumptions behind that forecast? How much are you going to, what's your revenue that you're going to sell it for? Is that realistic? Have you tested that? Have you done some surveys? Are there comparable things out there? What are people using to address the problem today that you're going to replace? How much do they pay for that? How much money are you going to save them if it's a medical thing? If you're, and I tell you, in medicine stuff today and in healthcare, if all you're doing is adding cost, you are probably doomed to failure, because you got to just coming up with better outcomes, better patient outcomes is a very hard sale right now. You have to demonstrate how you're going to net save a payer, an insurance company, or a hospital money for the most part. I'm sure there's some exceptions to that, but for the most part, you ultimately have to show how you're going to save money. And there are entire departments at hospitals now that evaluate that before they do anything new. But the assumptions are key. So is it, I put it here in quotes, is it connected? Meaning if, you could take revenue and say, oh, we're going to sell this many widgets and there's this many and there's this and the revenue and all that looks good, and go, okay, that makes sense. And then over here, you might talk about your personnel and you say, okay, we're going to hire this many people, we're going to do all this. And that all might make sense. But do you have the number of people you need to sell the number of units that you're selling? I mean, I've seen one where those are totally disconnected, and somebody says they're going to sell 1 million units and they have 3 salespeople. Can 3 salespeople really sell the 1 million units? And they go, oh no, we need a lot more people. And so they go into that, and you can just do some simple calculations as to, or assumptions to drive what those are, what those assumptions are. And then if you do all that, then you're going to make it defensible. You're going to be able to defend and tell an investor exactly why the different numbers are a certain thing. We think we can have one rep cover 7 hospitals in this region, and then it connects to the travel expenses and all that. And they may say, well, what if they can only sell to 6 hospitals? You ought to be able to punch in 6 instead of 7, and it just flow through your income statement. And if you can't do that yourself, find somebody who can help you do that in Excel or Google Sheets or something. In the early stages, the focus is really on the income statement and the cash flow. Again, the balance sheet does matter, particularly if you have to build a lot of inventory or you're going to have to hold accounts receivable for a long time. But for the most part, you want to look at the cash flow and the income statement. Burn rate, I'm going to talk about burn rate. I hate this term. You'll hear investors ask a company, you'll be asked if you take this to the next level and get the companies going. What is your burn rate? That term means different things to different people. Sometimes they just want to know, what are your monthly expenses? Other times they want to know what's the net. So if your company has revenue and they've got, let's say over the course of the next 6 months, they're going to have $20,000 a month of revenue and $50,000 of expenses each month. Well, their negative cash flow is $30,000 a month. Well, some people might say the burn rate is $30,000 a month. Other people may say the burn rate is $50,000. Let's say your revenue is $10,000 in January and is going up $10,000 a month each month. So it's 10, 20, 30, 45, and your fixed expenses are $80,000. Well, what's your burn rate? Well, in month one, your negative cash flow is $70,000. Then it's 60, then it's 50, then it's 40. So it's decreasing over time as your revenue goes up. And by the end of the year, you're positive. So again, I hate the term. People are going to use it. In that instance, somebody may want to know, what are your fixed monthly expenses, so that they can understand what's the break-even point. Break-even point is when revenue is equal to expenses. You break even. You get as much revenue as you do expenses. That's break even. They also might mean it on a cash basis, not on an income statement basis when they ask about burn rate. So make sure if you're asked that you can clarify exactly what they're looking for. And this is one that I've struggled with, again, in the medical space. If you're developing a device or you're having to pay something to get built, you may have fixed expenses for compensation, intellectual property payments, legal fees, rent, utilities, a little bit of travel. That might all be fairly consistent. And let's say that's $25,000 a month or $30,000 a month. But then you have a project from April through July that is a $200,000 project. Well, your expenses in those months are a lot higher. So if somebody's asking you your burn rate, well, it's uneven. It doesn't really work. So again, I'm never going to ask a company for their burn rate. I may ask them their fixed expenses, and so that get that $25,000, $30,000 a month number, so that how much, after they built their thing, how much cash do they need at that point? And that's really what they're trying to figure out, is when are you going to run out of cash? That's what how much money do you need, and when are you going to run out of cash when they're asking about burn rate? Questions on any of that? Brad, come on. No questions. All right.
Go for it. Brad, if you have a burning question, you go for it.
I'll wait to the end.
Pun intended. A burning question. Got it. So valuations, I told Shelby I would touch on this just briefly. When people are talking about valuations, they're talking about how much are they considering a company is worth when they're trying to figure out how much they're going to invest. You have pre-money and you have post-money, which I'm going to show you on the next slide. And ultimately, that is something that's going to be determined by investors. You can say what you want your valuation to be, but ultimately it's going to be determined by investors. Or you can put out there and say our valuation is X, and you might not get any investors because they don't think it's worth X, and therefore they don't want to do it. I'll show you here on the next slide, and sorry about that stray bullet point. That's what happens when you have an accountant do a slide deck 30 minutes before homework is due. You end up with stray things like that. So here's a calculation. Let's say that you've done this, you've worked, you've got your idea, you have your stuff, you've done customer discovery. Maybe you've gotten you've burned up your credit cards and you've gotten some stuff going, and you're going to try to get some seed capital, and you say, okay, my pre-money valuation is $2 million and I'm raising $1 million. So then the post-money, so take the value of the company without the money, you add the money, and those things together equal the post-money. So you say it's worth $2 million and you own 100% of it. And then an investor says, okay, I'll buy that. I believe that it's worth 2 million. I'm putting $1 million in. So your $2 million idea and progress and customers or whatever you have, together with my 1 million, makes this company, after the money's in, post money, worth 3 million. So then in that case, the investor would own 1/3. They'd have 1 million of the 3 million, and you would have 2/3, 2 million of the 3 million of value. And if you want to think of this in terms of shares, so let's say it's $1 a share, and pre-money there are 2 million shares, so it's $1 a share. You own 2 million shares. They buy 1 million shares at $1 a share. So now they have 1 million shares. There are 3 million shares outstanding. You own 2 million of them. They own 1 million of them. They own 1/3 of the company. They own 33%. That's typically how it's done. Let's say that you did this and they came in and said, you know, we don't want to invest $1 million yet, but we will invest 500,000. But if the same pre-money of 2 million and 500,000 comes in, so there are 2 million shares, you sell 500,000 shares, now there are 2.5 million shares, and the investor owns 500,000 of those 2.5 million shares, then that means they own 20% of the company, right? They have 5/25, 500 out of the 2.5 million, or 500,000 out of the 2.5 million shares. So they own 20% of the company in that case. The way that an investor is going to look at that, especially with something early when there's no revenue and they're going to look out 3-5 years down the road using your projections. They're going to cut those in half because they're not going to believe the made up numbers that you gave them. And they're going to say, okay, if the company executed and did this down the line, and it's making, Brad brought it up earlier, they're selling on Ebitda or a multiple of revenue. So using whatever the metrics are that are analogous to your type of business, what is that company worth down the line? So if I were looking at this company and we did the math on it, and down the line, it said that the company was going to be worth, let's say the company was going to be worth $20 million. Okay, down the line, 3 years, 4 years down the line, it's going to be worth 20 million. And based on this, the deal that you put in front of me, I'm going to own 1/3 of it. So I, assuming no more capital is needed, and I'm not going to get diluted, and there aren't going to be more shares, I would get 1/3 of $20 million is only 6.6 million for $1 million investment. That's only a 6x return. That's not going to be, that's a great return, but for all the risk that's still involved for something early, that's probably not going to compel an investor to stroke that $1 million check. So you might have to change that valuation. They may have to own a bigger piece of that. Or let's change it a little bit. Let's say that you've already done the calculations and you have a compelling story that says the business is going to be worth $100 million in 4 years. And so if they own 1/3 of 100 million, that's 33 million. All right, and I'm going to invest for a 30x return. You got my attention now. Yeah. All right, I buy that valuation. So that's how they're ultimately going to look at it, is what they're going to calculate what their expected return on investment is going to be. And if it's compelling, they're interested. If it's not compelling, they're going to push back and say your valuation is too high. Let's say that you were doing this and you said you wanted your pre-money to be 4 million pre-money. Well, then their 1 million is only worth 20%. Well, let's say it's going to be a $40 million exit. Well, 20% of 40 million is 8. That's 8x. They may push back and say, "Nah, I'll do it on a 2 million. If I have 30, if I can get 17 million, 1/3 of, or 13 million, 1/3 of a $40 million exit. Now I'm interested." So that's how that stuff works. I know Shelby mentioned, I probably went a little too long on that, Shelby, but that's what y'all are going to be talking about, I think, next week, maybe. But that gives you a good idea. So I'm going to stop sharing so that, oh, I'll do this. And so now I talked a whole lot. Brad asked a few questions. Hopefully everybody has a little bit better idea. Income statement, think about in your own life, your revenue, your paycheck, right? Your expenses, you gotta pay stuff at your, food and pay for the car and things like that. Those are your expenses, and whatever's left at the end of the month is your net, right? If you've quit your job or you're working a part-time job to pursue this startup, and you're supplementing those expenses with a credit card, then your accounts payable are going up. Your personal accounts payable is going up, and at some point, you got to be able to turn that around, right? Because it's going to start having it. Same thing with a business, very similar. Go ahead, Brad.
So I guess I had a question even before this lecture started. I'm curious if you can answer. Of all the startups that you've done accounting for, typically what do you see on the business owners or the major equity shareholders, co-founders? Like, Y Combinator has taught me that no matter whose idea it is, no matter how long someone's been working on it before someone else, it's always good. And you should always have equal co-founder equity split, no matter what, is what Y Combinator teaches. Like, of all the businesses you've done accounting for, what percentage would you say do have that equal equity split amongst co-founders?
10%, maybe. Pretty low.
Really?
Yeah, pretty low.
Wow.
Because if
it makes a
now look, if people start at the exact same time and they sort of hatch the idea together, then I agree with you. But if I come up with the idea and I start to develop it and I do a proof of concept and I run up all my credit cards, people talk about the first investors in startups are banks. People like, what are you talking about? Banks won't invest in startups. Yes, they do every day. It's called Citibank, Visa, American Express. Well, not American Express so much. But when they run those credit cards up, that's the first lender. And then friends and family, and then angels, and then you start to get to, organized VC. But no, if I started, it's my idea and I get going and then I meet somebody and they're sort of a co-founder and that they kind of came in sort of early. No, I that's the first time I'd heard that. Now look, Y Combinator is successful. They probably have rationale behind that. It reduces fights and this and that, but no, I haven't. I would say that's fairly rare.
That's really interesting to hear, I guess. Are most of your clients based in Memphis or?
Yeah, fair number are in Memphis, but we've seen a lot of deals from other places. And so I don't think that's like just a local thing that we don't know better or something around here. I've seen a lot of others are not equal. And it's a lot of, whoever's in there first is going to have the bigger percentage usually. But then now, from an investor standpoint, in my mind, the thing that's most important is, are the right people incented? Are they happy? If you have 70% of the management equity and Ryan over here is a co-founder, Ryan has 30, and after a couple of conversations with Ryan, he's complaining about his percentage. Well, I don't like that. Then I know something's messed up. But if I can tell Ryan's happy as a clam, I'm like, man, that was it was great. I didn't have a job. I didn't know what I was doing. Brad brought me in. I worked on this stuff and he gave me 30 and he's excited about his 30%. Well, then that's
right.
As long as everybody feels like
they're not
getting gypped, then that's what I care about more. And then what you're also going to see sometimes, and I have seen this, is you've worked at something for 2 years, you're pouring your heart into it and blood, sweat, equity, and then a big investor comes in and you think you have, 60% of the company and your early investors have some and they're going to put it, so they're going to own 20 and 20, and they're going to say, all right,
did your math wrong.
Your equity up and you're going to invest over time. Like, what? This was my company. What are you talking about? And that's, I mean, you got it. I've seen that more common now and now you can push back, particularly the longer a business has been around. You can push back and say, all right, how about, half of it is at risk, and then you earn it back. A lot of times entrepreneurs get nervous and like, oh, they're trying to screw me out of the company and they're going to kick me out after 6 months. And that's why they want this equity back. And then I'm not going to, that happens. But, from my experience, we never go into something wanting an entrepreneur to fail so that we can find a different entrepreneur to run the business. That's terrible.
Yeah.
if they have to get,
it just seems like,
they're going to really bet
like this.
Yeah, they want to bet on the team more than the product or idea. So they want you to succeed in that.
And that's always the number one thing. Like who's executing is like the number one, thing for a startup company in my mind. Like, and I guess I've been doing too much reading myself. Like, it's, from what I've read, it's like one of the number one reasons why startups fail, right? 90% fail. And like, what are the reasons for that? Like, is it because, what are the details that go into those 90%? And sometimes like I've read that most of the time it's like co-founders arguing, like, because somebody's, like you said, not happy or something like that.
Yeah, that
maybe that's happen. why Combinator went there. Yeah.
So a couple things I'd say in terms of companies failing, and Shelby and I talked about this a little bit. A couple things. A founder needs to have some humility, recognize what you're good at, and don't be afraid. There are lots of very successful companies and startups where founders have hired a CEO above them to run the business, knows what the hell they're doing. And they move over to, chief bottle washer or, strategy or chairman or whatever, and just focus on product or something like that, because they don't necessarily know how to run a business. But I mean, and as engineers and scientists, y'all haven't done a lot of business stuff, right? Then don't be
like knowing your skill set.
Don't be afraid to bring somebody in to do that part. Learn it. If you want to do one on your second one, your third one, learn it. So that's one thing I would give you advice on, is don't be afraid to have that. Another thing is, be careful about building a solution that's looking for a problem. Because if a lot of times inventors and tinkerers and somebody who has an aha moment, they get really focused. It's really personal to them. Like, oh man, I was going to the grocery store and a shopping cart hit my car and it made me all mad. And so I came up with this idea to put brakes on shopping cart wheels. Like, yeah. And somebody's like, everybody go, oh yeah, it's the greatest idea ever. I hate that too. Well, okay. It's not practical. It's, it's not, whatever. It's never going to work. And a lot of times people won't tell the person it's never going to work. And it's just, yeah, you had a problem, but it's not that wide of a spread of a problem that it needs a solution. If you find, in medicine, if you find something where hospitals spend, billions on hospital-acquired infections. If you have something that can address hospital-acquired infections, now you've got a solution that has, a problem that needs a solution. So just, again, that's part of that humility of making sure that I'm not getting caught up in my own euphoria and getting, kind of confirmation bias because I'm asking friends about it. You got to ask people who aren't afraid to tell you, nah, that sucks. Move on to something else.
Raw feedback.
Yeah.
I've got a quick question since Brad brought it up. I know that, the Y Combinator sort of pioneered safe agreements a while back, especially pre-money safe. And now that they've moved to post-money safe agreements, what's your opinion on safe agreements as an investor if a company comes in with a safe already in hand?
Yeah, so a few things, two or three things about safes. One, it's positioned as this being novel and all this stuff. It's basically convertible debt. So it's really not, it is different, I guess, a little bit, and has some different attributes. But it's basically convertible debt. If it's a strict safe that is a discount to future equity, 20 or 30% to a future equity round, I have no interest in it. And now if it's a safe that has a discount and a cap, a valuation cap, then I can get on board with that, because to me, that's like convertible debt that has a stated conversion. And here's why, Ryan. Let's say that I could write $1 million check. I can't, so don't come to me asking for $1 million check. We do, by the way, I am a partner in a fund. It's an angel investor fund. Our typical first investments are $50,000. If something's really exciting, our LPs sometimes will add extra. We've done as much as $300,000 combined with the LPs in deals. So when it's time to raise money, you're welcome to come talk to us. And if you, even before you're ready to raise money, you guys are welcome to pitch to get feedback on what you have. But if you, so let's say you come to me and I give you $1 million, and if I valued the company today, it's back to that other example of, I think it's worth 2 million today, and I give you $1 million, so I should have a third of it in my mind. But you take my $1 million, you go do a bunch of really good stuff, and you raise a future equity round at a 5 million at a $15 million pre-money. Well, great, I get a discount, so now my million's coming in on a $12 million valuation. Well, that sucks. If you just give me the price that I should have gotten today. So you're gonna, let me get this straight. You're gonna take my money, use my money to greatly increase the value of the company, and then I'm gonna get my equity on that higher value of the company. I got no interest in that. Now, if there's a cap that says, okay, we could argue, should it be 3 million now? Should it be 4 million now? You want it to be 4, I want it to be 3. Maybe we say, okay, we'll do it at a 20% discount with a $3 million cap or $3.5 million cap. Meaning, if you go out and take my $1 million and that other investor is going to come in for the $15 million valuation, well, my million converts at that, $3.5 million valuation instead of the other. So yeah, you've used my money to build up that other, and yeah, I'm paying a little bit more than if I had just done this, but I look at it more as I want that cap to be whatever I would do if I were going to write a check for equity today. And it's really more, to me, it's saving the cost, the legal fees, because you can do a safe for, $1,000. You can have an attorney look at that, or a convertible note for, less than $5,000 of expense. You can have a good convertible note or safe agreement that has a cap. And so, it gets around doing all the equity stuff, because when you do a priced equity round, it's crazy now, guys. I'm seeing, and ladies, if we have any ladies out there, I'm seeing like $40,000, $50,000 of legal fees to get an equity financing round done. All the stuff that has to happen, because you have company attorneys, you have investor attorneys, the investor attorneys are reviewing the company stuff. And I've seen them well over that number. I think the minimum I've seen lately is $30,000, $35,000. So if you're doing a $300,000, $500,000 round to get some stuff going to kind of prove out safe or convertible note, but don't use it because you're trying to save equity and build up the value before that converts. Do it because it's a cheap way, and go ahead and state whatever that, agree that there's going to be a cap at whatever you normally would have done. So something reasonable, $1 million, $1.5 million, $2 million type valuation, the early kind of C type valuation. Does that help?
Thanks.
Shelby, I guess we've got half of next week covered, right?
We do. We have answered a lot of questions. It does preface it well for funding next week, which is what we're going to cover.
Yeah, we've gone over today, but it should make next week shorter.
Yes, right. I'm going to tell Brian that. So everyone that's here, tell Brian that, hold him to that next week.
Yeah. So I don't know what y'all's agenda is. I guess more questions, office hours.
Yes. Okay. So first of all, thank you so much. I hope that all of you found that really insightful. It's definitely sets us up well for next week. So tomorrow from 2 to 4 p.m., Andrew has availability for office hours. One team is already signed up for office hours. I will drop in and out of office hours tomorrow, but sign up for me anyway. If I have the slot open, it doesn't hurt. We can always do it on a call instead of Zoom. So I really encourage you to sign up for office hours tomorrow, because Andrew's nice enough to give us the time, and he has some good tools too that we talked about yesterday that could help you guys out a lot. What I ask that I wouldn't normally ask is, can everyone please sign up by 8 a.m. tomorrow morning? Because I would like us to figure out how much time we can give Andrew back or how much time he needs to dedicate. But same for me too. How much do we need to dedicate? So try and sign up by 8 a.m. tomorrow morning. That would be really helpful. But obviously you'll get the office hour sheet tonight when we're finished with the call.
Are we limited to 20 minutes, or if no one signs up, can one team get 40?
If no one has signed up and Andrew's okay with that as well, then Brad, you eat your heart out.
Yeah.
Yeah, thanks for the presentation. It was really good, Andrew. Thanks a lot.
I've blocked off the time. I will show you all this other thing just really quickly. This is what I was showing Shelby the other day, yesterday. So this was the deck. It was created out of this document that I'd written that explains all that stuff I went over on the deck. And then at the end of this, and this gets in more depth on valuations. If you read all of this section, I'll PDF this and send it to Shelby so she can send it to y'all. If you read this section, that'll really set you up well for next week and understand all those things. And at the end of this, I have assumptions for how actual financial, like accounting, bookkeeping entries work. And I do it kind of month by month with just a few little things and to convey different concepts. And then I have an accompanying Google sheet that does each one of those. So in month one, I have, this happens. Okay, here's what it looks like on the balance sheet. Here's what it looked like on the income statement or cash flow, statement of cash flows. And then month two, the activity and what it looks like at the end. So it's a pretty good tool. I'll share this. I'll probably just go ahead and make this an Excel sheet and send it, download it as an Excel and send it out to y'all. That way you can play around with it. And then the other as a PDF. But happy to cover some of that tomorrow during office hours if people are interested.
Great. Well, Andrew, thank you so much. I'm not going to force you to stay on for the rest of the time. You're more than welcome to if you can, but we really appreciate it.
Yeah, I'm a little bit zoomed out. I think I've logged about 7 hours of Zoom time today already. So
you're good. Don't
I'm getting texts about dinner from the other side of the house. I better go check out, see what I need to be doing over there.
All right.
And
well, thanks so much. We appreciate it.
I do have a question for Caitlin. Was that at a zoo or did you get to go to Australia?
It was at a zoo.
Oh.
Hopefully I get to go to Cape Town though for field work. So that's why I'm crossing fingers on.
Gotcha. Yeah.
At the zoo.
I want to go to Australia. That's
Oh yeah.
I definitely want to go. Although I am getting a little bit scared by all the things that they say, all the things that'll kill you in Australia.
Well, what doesn't kill you these days? I don't know. Like
Just buy 2 tickets. I'll watch your 6. You watch my 6. That's how we'll get around Australia.
All right. I'm in. All right. Thanks, everybody.
Thanks.
Bye.
thank you.
Thank you.
Thanks.
All right, y'all. I'm going to Zoom, no pun intended, through this session. Because it is a lot, and that's fine because that was awesome. Andrew is a huge asset to the entrepreneurial community here, and I can't even begin to quantify how much all of that information that he just shared with us probably would cost in their office. So definitely grateful for that. All right, can y'all see my screen? Yes, okay, cool. Well, let's see if I can do more than that. There we go. Let's do it like that. Is that good for everybody? All right. I'm going to work off of two computers. Okay. All right. So channels and business development. So we're going to go through that, and then we're going to go through corporate formation, and I'm going to go as fast as possible. So the next topic we're covering, channels and business development. So first of all, let's start off with what is a channel? A collection of inbound and outbound resources, networks, connections, business relationships that are required for the successful sourcing, marketing, sales, and distribution of products and services to end users or customers. But channels are not just about marketing, and that is most often what is associated with channels when we talk about that in an entrepreneurial setting. So you might hear that word associated with marketing a lot, but it's not the only channel to success. We're going to talk about the ones that are separate from marketing channels first, because you can't market something if you can't source it, procure it, fabricate it, etc. So it's important to cover and recognize that those are channels as well. So inbound, upstream channels, same thing. So we have material sourcing, third party or remote manufacturing. That's either by part or in whole, or maybe someone else is assembling it for you. Third party product fulfillment. So you're doing like drop shipping. You have no products, no warehouse, etc., but you're selling someone else's product. Third party sales, logistics and distribution. Inbound. So everything you need to get all of your sourcing material inbound. These are some examples of upstream channels, everything you would need to manufacture your product or service. Next would be outbound and downstream channels. Logistics and distribution. This is outbound. This is the customer. Reverse logistics and disposition, meaning when something's not to the customer's liking, they're going to send it back. So what do you do with that? You have to think through that. And a great example of this is Wayfair. So Wayfair will send return items to overstock instead of stocking them back in their own inventory. That's an outbound downstream channel. Next is retailers, value-added resellers, direct sales, indirect sales, customer service reps. These are all the people interacting with the customers and everything downstream. So then obviously, like I said, it's not all about marketing channels, but marketing channels are what people usually think of, and they are extremely important. So a business methodology that attracts customers by creating valuable content and experiences tailored to them. Inbound marketing forms connections customers are looking for and solves problems they already have. These are inbound marketing channels. So this little wheel to the side is called the Flywheel. It's from HubSpot. Basically, the point is that you're supposed to attract, engage, and delight your customers. This can be done through social media, blogs, vlogs, podcasts, which are becoming more and more popular, webinars, press releases, things like that. So inbound marketing, Flywheel, we'll talk about this a little bit more. Inbound marketing is ads, video content, blogging, social media. These are all things that you're just going to put out there in hopes of attracting a customer, hence the attract part on the Flywheel that you see. Then once you've attracted them, you're going to engage them further through directed email. An example of this would be MailChimp, if any of you have ever heard of or received an email from that marketing software. Lead management, marketing automation, customer service reps for calling, and upsales. Then after that, you delight them further by giving them even more specific information as you're interacting with them, using content like did you know, taglines, suggesting products or services to those specific customers that meets their needs. The goal of this is to build a long-term relationship with your customer. So you can kind of see how the wheel works. A person is a stranger first. You then attract them. Then they become a prospect as you engage them. Then they become customers as you delight them. And eventually those customers, when the wheel is complete, become promoters. brand ambassadors. TikTok has made that a really popular term for people to use. Promoters, brand ambassadors, company champions, whatever you want to call it. As you move through this wheel and this relationship, your customers become actual champions of your product. A big mistake that I've personally noticed in working with startups, industry agnostic, is not taking this customer, this wheel essentially, seriously, to not build long-term relationships with them. Doesn't matter who your customer is. Doesn't matter if it's a person. Doesn't matter if it's a hospital. Doesn't matter if it's a smaller clinic. It doesn't matter if it's a doctor. When I mean person, I mean lay person. A doctor. It doesn't matter who it is. Another medical device company. Doesn't matter. This is an important tool to use to build long-term relationships with those customers. All right, next. So marketing channels for outbound. So then the outbound channel is just that, it's outbound. This is email blasts, cold calling, trade shows. We're just trying to initiate a conversation here, basically. You're hoping to get as many prospects as you can while giving out generic messaging to a large group of individuals. Anyone that comes back to you through that wheel. Okay, that's marketing. Does anyone have any really big questions, or can we save them to the end? I also can't see if people's hands are raised, so if somebody could just unmute. Good? All right. All right, let's get into corporate formation a little bit. So here's Brian's favorite photo to use. What type of business should I be? We'll discuss 6 types. So corporate formation types, we have LLC, S Corp, C Corp, nonprofit, sole proprietorship, general partnership. We can go a little more in depth for each of these. So for an LLC, limited liability company, Brian and I share the recommendation that companies should start an LLC first. Limited liability companies are the easiest to launch. It's literally just registering with the city, and you can file in any state that you want. And it's not expensive either. For an LLC and for a small business incorporation, you can set them up in any state. You don't have to reside in that state. Randomly enough, Wyoming is a really great state to do this in. It has no state tax. They only charge your annual filing fee. It's easy, cheap, and quick. Plenty of people do that. Brian has an incorporation in Wyoming as well. Delaware is another popular one. We'll talk about that in a second. But again, you can incorporate right here in Memphis if you want, or anywhere else. Just understand that wherever you do incorporate, you're responsible for the tax liability for that state that you've incorporated in. And those laws change state to state. So S Corp. An S Corp is a corporation, but the shareholders share the liability of the tax. So everything is basically on the shareholders. It does provide some protection for the shareholders, but it's a business entity that passes almost all of its financials through the shareholders. The shareholders then pay the taxes on any gains and losses that they have within. So the same goes here with the fact that you can set these up in any state. You do not have to reside there. So I mentioned Delaware a second ago. S Corp, C Corps, and bigger things often incorporate in Delaware because it's very corporate friendly. Now, as we have political administrations move in and out and tax structures change, you have to stay up to date with this information because this can also change because of tax structures changing. But historically, so many, I would say most Memphis startups that I saw when I was with Startco incorporate in Delaware at that time. So C Corps. A C Corp is different because the corporation itself is responsible for income and loss. The shareholders are not. So the shareholders are only responsible for their own personal gains and losses as they would apply those to their taxes, if that makes sense. C Corps are the best to set up if your goal is to sell your business later on. This is important for medical device and medical companies. I have seen more often founders of those companies be more upfront with the fact that their goal is to sell. They're not trying to do this lifelong. They don't want to be in a CEO role forever. They want to sell. So keep this in mind that C Corps are friendliest for if that's what your goal is. It's also best for if you have an operating agreement where the business itself owns all the property and everything. You can bring money in, you have to have a board of directors, but you can bring in large institutional and private funding into a C Corp easier than any other corporation. And although they're different when we talk about LLCs, C Corps, S Corps, this is all about keeping your personal assets separate from the company. So it's important to remember that. Nonprofits. Nonprofits are similar to a C Corp, but generates no profit, obviously, and is tax exempt, usually for a specific cause, generally public, and specifically for the members of the nonprofit or groups of people it's trying to support. Nonprofits should be run like a for-profit to maximize inbound assets and revenue. I can't stress that enough. You can have a nonprofit, that is great. You have to run it like a for-profit though, in order for it to be successful. What does this mean? Nonprofits are not a non-revenue company. They're a not-for-profit company. So this doesn't mean you can't generate revenue, but those monies go back into your programs and into the nonprofit itself. An important distinction to make, I forgot to add this to the slide, an important distinction to make is that a nonprofit is different than a social enterprise, but the two are often confused. You don't have to be a nonprofit to have social good as a part of your company, or even to have a social good as the majority part of your company. You can be a for-profit company while being dedicated to social good by being a social enterprise. Goodwill is a great example of a social enterprise. Okay, so sole proprietorship. This is where you have all of the liability. In a sole proprietorship, the business and the person are the same. You are one entity, so there's no legal separations between the two. General partnerships are more like venture capital firms and holding companies, things like that. All members are responsible for financial and legal damages. So it's more similar to an S Corp in that type of way. Okay, so considerations. Bear with me through this because I'm going to explain a few things and it's kind of like drinking through a fire hose. So first of all, create an LLC while you're in the concept stage with a pre-incorporation agreement associated with it and a basic operating agreement. That's not something, we're not saying you have to do that, but Brian and I both, again, share the same outlook. It's important to do that. So create the LLC in its concept stage, then incorporate later in the funding stage. But when you do go and create that LLC, make sure you create a pre-incorporation agreement prior to the formation for the founders. We'll talk about this more. Why do I say that? When you have a pre-incorporation agreement, all founders can get on the same page as to what each person owns, their intent, requirement to assign all personal and intellectual property that's related to the company or business itself. It gets them in writing basically to say, and when I say them, the founders, to say they will sign the IP needed for the business to the business itself. It gets a lot of the conversation over before you've even really started your business. And it helps really solidify some commitment there. An LLC can be set up with 2, 3, 4 people, etc. This way each person has equal footing depending on how you do the operating agreement, and you all collectively own the business. Then after that, you can talk about stocks and how to transfer that into your pre-incorporation agreement, all of that. Once you have incorporated, your legal personnel has all that documentation. That way they can go ahead and put it into your incorporation paper. So you're also saving them and yourself a lot of work and more money at that point. Also create an LLC before incorporating, because you're taking in smaller amounts of funding at that time. So it's not really necessary to immediately have to incorporate. So the third piece here, I mentioned this a couple with a pre-incorporation agreement. IP needs to be assigned to the legal entity. There's no law saying this, so I want to clarify that. But the reason we really stress this is because if the business doesn't own the IP and the person who does decides to leave the company for whatever reason, your business is gone. They take that IP with them. You have no footing to stand on. That can be a really sensitive issue sometimes, and we definitely understand that. But for the protection of everyone involved, even for the protection of the person who owns the IP, assign the IP to the company, to the business itself. Save yourself and your fellow founders and your investors a lot of trouble. You will have a very difficult time raising money from investors if the IP is not assigned to the company. Fourth thing, vesting. So vesting by all founders is critical. What I mean by vesting is a timeline for the proportional distribution of ownership. So basically it's just spreading out the founder's ownership. An example. So if Ryan and Erica had a startup together and we were on a 3-year vest where the first year, so I put Ryan and Erica on a 3-year vest, where the first year they don't vest anything until the end of their 12th month with the company. At the end of that 12th month, they get 25%. So after 1 year of working in the company, Ryan and Erica get their 25% of their ownership in the company. Then every quarter after that, for the next 2 years, they'll get another 9.3% of the remainder of their ownership. Does that make sense? You're just spreading their ownership out quarter over quarter. The reason that we do this is basically, or that we recommend that people do this, is basically because spreading out their ownership gives funders and founders some security that no one is just going to up and walk away, because you want your ownership in your company. These are just numbers I use. These terms are just an example. There are plenty of other ways to do this. We just recommend that you put the founders, those that have ownership in the IP, on at least a 3-year vest. Ooh. Okay, I don't know how we were able to get through that so quickly. That was a miracle. But homework for this week. So homework, we're going to get more into funding and stuff next week. Like I mentioned when Andrew was on the call, I know that was a lot of information I just gave y'all. Our homework is actually not related to that. So if you want to talk more about the things that we talked about today in office hours, sign up tomorrow. But also Brian will be back in town next week. He knows a lot more about corporate formation than I do. So feel free to schedule some time with us outside of office hours. Okay, so moving on to homework. So like I said, we didn't talk about this week, and this might seem kind of strange because we haven't talked about competitive analysis matrix outright, but we have talked about competition a bunch when it comes to understanding what your problem is, seeing if there's anyone out there already solving that problem. When we've talked about customers and how competitors are serving those customers already, we've talked about it in solutions, talked about it in the market. So we've talked about competition. Several of you have actually already listed competitors in some of your homework that you've submitted. So this assignment should not be super difficult. Google is your friend here. So I want you to build a competitive analysis matrix. What you'll do is you're going to list 3 to 5 of your competitors on top. And on the sides, you're going to list the 4 features on the left. Demonstrate, you can do more features, you can do less features. I would not do more than like 5 or 6. And I wouldn't do more than 5 or 6 competitors on top either, just so it doesn't get so, convoluted. But yeah, list some features on the left that you have, and make sure that they're things that not all of your competitors have. Because you're going to want to demonstrate it. You can use check marks, X's, whatever. But the purpose of this is to really show how you're not only different from those competitors, but that you're better than them. So it should be fun. It actually should be a pretty quick homework assignment because, like I said, Google's your friend here, and you can get that done pretty well. And if you get stuck on features. Revisit your value proposition. We've talked about that. What are the most important features of your product based on your value proposition? And then list those in there. Second homework assignment is to create a list of known obstacles for your product service. 5 to 10 of them. You can put this in a spreadsheet. You can put this in a doc. You know, doesn't have to be overly complicated. Known obstacles are what you have to overcome. So clinical trials, development, access to technical resources, money, funding, finances. There's really no wrong answers when we're talking about known obstacles. So just brainstorm a little bit, brainstorm as a team, search some stuff on Google, figure out what your competition is doing. And yeah, those are your homework assignments. Obviously, let me know if you have any questions with them. I'll upload this to the drive when we're finished so you guys can revisit it. But when you're finished with your homework, please upload it. Now that you do have permission to upload, please upload it into the drive. And if you have any issues, just shoot it to me and I'll stick it in there. And as always, thank you to our program partners. Thank you to all of you. And we are finished, and we are a minute early. Actually, I should keep talking for a long time. I'm very proud of that. Does anyone have any questions since we are a whole minute early?
I had a quick question.
Yeah.
So when you're talking about the competitive analysis matrix, I guess the goal for that is purely marketing, right? We aren't trying to be really honest about comparing things, but really just highlight what features about our product are better.
Yeah.
So really.
Exactly. Say what's on the better end. Cause I mean, you don't want to get up there and list you don't want to get up there and list your competitors' features that you don't have. I'll say.
Okay, all right. Just making sure. Yeah.
Yeah.
So it's not something introspective. It's something that we're trying to do for
right.
as a marketing feature. Yeah.
Yeah. This is, I mean, it's definitely for selling, definitely for marketing. The goal of this is for it to eventually go in your pitch deck as well. So yeah, keep that in mind. Keep your features in mind. Don't do your competitors any favors.
All right. Thank you.
Yeah. Brad?
So have you read the book Blue Ocean Strategy?
I have not.
So if one of the teams has decided to go into a blue ocean market, there's very little competition, I guess, because it's a blue ocean solution for some kind of problem. Like you're creating new value somewhere. And I guess we haven't really decided yet on, because we're building backwards with ours. It's like a solution that, like Andrew said, we're trying to find a problem to bolt it to. So I guess like this homework concerning like a blue ocean problem or market space versus like a red ocean that has a lot of competition already. Like the wound space, I guess, that Sweet Bio's in is really competitive, and it's really red ocean, and like it's really hard to set yourself apart. And like, you know, basically like Andrew said with healthcare market, you're basically trying to take cost out. Like patient care advantages are a hard sell, like he said. So I guess my question was blue ocean versus red ocean market. Like it may be like a big, you know, homework assignment, or if it's a blue ocean, like it may be kind of tough for us to find like competitive analysis. Maybe I'll just do both actually now.
Right. I mean, are you saying that you're concerned that you're unable to find enough competitors to list?
Depending on which market we choose, yes.
Okay. I would choose, for the purpose of this, I would choose whichever market is the most saturated in your opinion with competition and start with that. Okay. Because that's easier to do a competitive analysis matrix on, is the more saturated market. Because I want to see personally, I want to see how you are different than the people in your saturated market. Okay. So I would start with that one. And then as far as the market that is not as saturated with competition, let's wait on that one. Let me wait till Brian gets back in. I'll see what he thinks about it. And he might want to see that too. There's no telling, but I would prefer you show me, yeah, I want to see how you fight in a market that's already saturated versus if I'm a customer looking at your solution in a market where you have no other competitors or very little. Well, of course I'm going to choose you. I have no other option.
Yeah.
So yeah, show me what you got.
Okay.
What you
Makes
with.
sense.
Yeah.
Thanks.
Yeah. Anybody else?
Will Andrew's PowerPoint be shared with us?
Yep. Yeah. I'm going to upload it to the drive tonight along with that tool, the financial forecasting tool.
I was going to say one thing, just thinking about the competitive landscape. You mentioned not putting something on there that all of your competitors have and you don't. But also, I had this on one of my competitive landscapes and I had to think about it and I was like, yeah, that doesn't make sense to put that on there. But if it's a feature that everybody has, is it really a feature or is it a requirement for the device? So that's the other thing too. Think about, like, for instance, what I'm doing, if everybody has a portable device versus one that has to plug into the wall, is that really a feature or is it actually a requirement for the device to be functional and provide an advantage for all your customers? So also consider that too when you're thinking about what to put on your competitive landscape. Does that make sense?
Yeah, that's great. That's a good point. Anybody else? All right. Well, thanks guys. I appreciate it. You're going to get a email with a bunch of different things in it, links and stuff from me. So just make sure you read through it carefully so you don't miss anything. And like I said, office hours, try and sign up by 8 a.m. tomorrow morning. That would be great. And if you don't, then Brad's going to take all of your spots. So. All right, guys, have a good night.
Yeah, thanks. And great choice of guest speakers like you guys, like especially with Christine at MRC, because she really knows her stuff. Sounds like Andrew's really prepared, knows his stuff. That's really nice to see that you guys are picking like A players to come and speak to us. So appreciate the hard work on that end.
Great. Yep. Thanks. I appreciate the feedback.
See you guys.
Bye.
Thank you.